Welcome back from the break. Hope you got a break, some food, or did some push ups or something to get the blood pumping, which is what I like to do during those breaks. We are going to be continuing now with squats and reversal recoveries, starting on page 350. This section is a fairly quick one, only about 15 minutes or so, and then we'll get into selling, but we will take a 5-minute break after this section of selling. So let's get back to Mark and Mark.
Okay, welcome back. We're on squats and reversal recoveries now, and we want to show you how a breakout sometimes will fail to close well on the initial breakout day. And I've seen a lot of people, a lot of traders where, they'll sell the stock if it pulls back and it doesn't have a decent first day of a breakout. And if you're really, really short-term oriented, you certainly could do that. If you're, especially if you're taking very small profits, you're a day trader or you're a very short-term trader, well, you can maybe, choke the trade off. But we find that a lot of the stocks will do this, and but they won't hit your stop. If your stop is set at a reasonable level, the stock price is coming out of a very tight pivot, and maybe your stop is below the pivot 5, 6, 7, 8%. A lot of times, what will happen is the stock will stall out for a day or so, sometimes as much as a couple weeks, and then it will recover that pullback high, that squat or reversal high. And so we call that a reversal recovery when they can take out that high. So first there's the squat. The squat is just simply stock tries to break out, and then it pulls back and it closes in the mid to the lower end of the range. And it looks like, the stock may sat down in the lower end of the range. So we call it a squat. So here, it's a perfect example. And we actually, this was the feed from our platform where we added it to buy alert a couple of days earlier, prior to it trying to come out here and break out. And then finally it broke out or attempted to break out, but ended up squatting. And that would have gotten you into the stock because it had taken out the high and the pivot, but it closed down and you would have been at a little bit of a loss. But again, just a stop below the pivot here, it never breached it. So what I often advise is that you start off with an amount of risk that you're willing to take, and go into the trade. Once the trade pivots and it moves to the pivot, buy the stock and then stick with that risk and try not to circumvent that risk unless you start seeing the violations piling up. If you start seeing ominous signs and there's a number of violations, okay, then maybe you can cut back or even cut the stock out. But you should have already determined how much risk, position size, and calling an audible it could be very emotional. If you start watching the stock and it doesn't go right away, and now you get emotional and you get worried that it's going to stop you out, and now you sell it before it stops you, and then it turns around, it takes off, and you sell a big winner when you unnecessarily. So what we try to do is give the stock at least a few days, if not even a week or two, to try to stage what we call a reversal recovery. And here's a perfect example where we try to break out one day, it takes out the low. And that's where a lot of times these will also, they'll take out the previous day's low. And then a day later they go, because what happens is even the guy who says, well, I'm going to hold it, I'm going to see what happens here. It's squatted, but I'm going to wait. And then the next day when it takes out the low, that's what shakes them out and freaks them out. They're like, all right, or they even set the stop at that day's low. Next day undercuts that and creates that, once again, that shakeout. And those are the very finite amount of weak hands. And once the weak hands are gone, the stock can go, right? Just like we've been talking about. So now you see, bang, it just blasts off and off to the races here. Acts very good. Now you see, same thing applies here. Look how it comes off for a number of days here. You've got a couple weeks, and then in one day, boom, right into new high ground, tennis ball action. So it's acting fine. Let's take a look at another example. So this is Micron Technologies. So right here, I actually bought this stock when it started moving up right here. It squatted, and then a couple of days later, you had a 2-day reversal recovery. Then you pulled back right here, and then again, we don't know this is a natural reaction until we get tennis ball action. So if this stock just kept going down and down, and now it's below the 20-day, it's below the 50-day, we've got 3 or 4 lower lows, volume's picking up on the downside. Well, now the natural reaction isn't so natural, but this just pulled back right to the top of the breakout. You would have never been at a loss. And then within 2 days, right back into high ground. That's acting perfectly fine. Nothing wrong with that. So, and this can happen a number of times. Here you can see you had this little pivot right here, kind of tight. Again, you got the squat the very next day, 1 day down. That's the little shakeout, shakes out the weak hands, and now it retightens. It actually improves. This is where we get an improved setup, because now you've got the shakeout. And again, you just be recounting here. Here's your first T, second, third, and now you've got fourth contraction, super tight. You can see, look, the volume comes down to almost on that last day there or so. It's virtually, you can't even see any volume on the chart. I know it's kind of squished here. Then again here, same thing. You break out, attempt to break out, squat, comes off the next day, takes out the low. And then a couple of days, you're back, boom, you come out again. You actually squatted again on that, on the reversal recovery. And then it moves higher from there. Let's see. So Sunji, again, comes through this little low chi area, squats, runs into a bit of supply, but then the very next day, you get a reversal recovery, and then it's off to the races here. Now you look, pulls back, 1, 2, 3, 4, 5, 6, 7 days down, you're back into high ground in 3 or 4 days, right? So again, everything is going to apply the same thing over and over and over, and you got to get consistent. You're first of all, the first thing you need to be consistent on is the criteria and being disciplined to only trading the stocks that meet the proper criteria. Then you've got to be disciplined in your application and in the way you apply it, because you have to take the signals. You have to execute, and you have to do that without letting your emotions override your the charting and the facts and the information that's being presented. So that's why we have these rules. You want to be as rule-based as possible and remove as many emotions and moving parts as possible. I remember we did that interview for oh God, I got a brain lock.
Real Vision.
Real Vision, yeah. Sorry, thank you. We did that Real Vision interview, and I remember the interviewer asking me and asking both of us, Mark, if you remember about emotions. If you get emotional and if let the emotions override, and my answer was there's no emotion at all. When I place a trade, I'm like Spock, from Star Trek. I am really emotionless, because it's just I'm just going through. The stock sets up, the pivot points there. I put that trade on. I mean, maybe if stock takes off and it's up real big, I certainly I get happy, and I'm unhappy when the stock moves against me. But there's not much emotion around the trading, and I'm just getting inquisitive. Even when it moves against me, instead of getting upset and getting worried, I get inquisitive, and I say, okay, well, what's going on here? What does this mean? What could I have done differently? Did I create this situation, or did I do everything right? And it's just, the market's not right here. So I get very curious, and that's one of the ways to keep the emotion out. Again, this will happen from low cheats, handles. You're going to see the same thing happen over and over and over. Very often, stock will try to come out, squats, either the very next day, takes out the high, or undercuts that low for a few days, creates a little shakeout. Or you might even get where if the market's, a lot of times this happens and the stock will try to break out, but then the market gets weak. Next day, market gets clobbered. The indexes are down, so it pulls the stock down. You get another few days down, stock comes in a few days, but it hasn't hit your stop yet. See, I don't care. I don't mind when I buy a stock, I don't mind if it doesn't take right off. And if the market comes in and holds it back, as long as it doesn't hit my stop. If it's trading above my stop, then my risk reward ratio is intact. All right. So that's the main thing that you have to concern yourself with, is having that stop set at a mathematical level that's commensurate with the type of reward that's going to pay for that risk, and then managing the position around that. I'll show you a few more here. I traded this one. This was L3 Communications. Tried to come out here, and this was a pretty ominous. Usually, when you get an outside day like this, it closes right on the low. If it's on big volume, which it wasn't, usually I'll trim. I'll trim my position a little bit. On this one, I remember it tightened up. I did not trim, and I actually added to it, and then it took off from here.
Mark, I just wanted to add too, that was one sort of one thing to track is the idea is the size of the squat. I found if it's a really big squat, it definitely that's a little bit of well, not a little bit, it's more of a negative where if it were to break out by 7, 8, 10% and then come all the way down, and then to Mark's other point, volume is the other thing I look for, because if it squats on big volume, it just tells me that there's potentially more supply there.
I meant to say that, and that's a great point, Mark. Thank you. So yeah, again, if it looked like this, and let's say the volume here, it was like this, it was the largest volume. Now, yeah, that's going to take a lot to recover that high, because there's so much. And I know the question will probably be, well, how much? How big of a range? How much volume? This is one of those things that are going to have to be more determined case by case, and it's really a judgment call. But when you start getting where maybe this stock is up 10-15% on the breakout, and now it reverses everything and closes below the previous day's range, and you get an engulfing day and the volume comes in, that's pretty ominous, and that's worth trimming the position. But if you're getting, what I'm talking about is action that is not, it has not hit your stop, there's no violations, and the volume is not real suspect, and there's not a huge reversal. Give it a chance, see if it can quiet down for a day or two, and even a week. Like here, you come out of this this low cheat, it squats, it takes 1, 2, 3, about 4 days or so, and then it starts moving again, and then you get that reversal recovery. Sometimes they can take even a couple weeks if the market's weak. Again, here you go, you squat very next day. This was LinkedIn. This is remember before I showed you the large chart of LinkedIn. Prior to this was the IPO, and then it went through that big correction. This is that right side where it started to tighten up, and this is where I was buying it right here. With Amazon, we go all the way back to 1997 when Amazon was coming out of that first primary base. It actually squatted, then had a nice reversal recovery, squatted the next day, and had another reversal recovery. I thought it was interesting that it happened a couple times in a row. I'm just showing you some examples here. Now, I want to also show you, and again, here's a perfect example where, you get this squat, and if you panicked out of it, 3 days later, it takes right off here. And, this is up 80% in 13 days. So, you can really cut off some opportunity. You need to allow that risk reward ratio to play out. All right. If you choke the trade off too quickly, stocks do fluctuate. They have to fluctuate a little bit. And as we said, that the best sign is that you're at a profit right away. But right away doesn't always mean that exact day when it first breaks out. Sometimes it takes a few days to get that move going. You can also see here the volume characteristics where you get that low volume, and then when the stock is moving out, the volume comes in. You see that contrast, that 1-2 punch. It's happening over and over and over. I want to show you here real quick. I just show you this because this was at the time one of the biggest trades I ever made as far as percentage wise. I bought this, and it did have a squat. This is going back to 1995, which happened to be one of my biggest years. Up to that point, this was the biggest year that I had. I was up 413% that year, and this stock helped that a bit. I bought it on July 28th. I sold it on about a year later, and held it through this whole move here. And the reason why is it held the 50-day the entire time. I sold it on this day right here because it closed below. It was just getting just below, and it was about to close below the 50-day, ended up closing below the 50-day, and I just sold it right there at the end of the day. And this was actually my confirm from that day. This is when we actually had to pick up the phone to make to make trades, and it was a very arduous process. But this was actually real deep discount commissions back then, $25 plus a $4 SEC fee. Prior to this, I was trading at oldie discount for $60 a trade, and that was just a couple years earlier than that. And then prior to that, before oldie discount came out with the discount commissions, and there was a few discount brokerage houses, we were trading at $150 to $200 a trade. But you can see here, so I just bought 1,000 shares there, and that was the trade. I thought this was fun to take a look at. So we're going to take just a really short break, and then we're going to come back, and we're going to start talking about sell rules and how to identify a top, and how to go looking at how to identify where those specific sell rules within the longer term time frame, where you get these specific things that can happen that are going to give you the warning, if you will, the red flags that you should be selling the stock, nailing down your profit, and avoiding a stock that may get into those stage 3 or stage 4 downtrends. So we're going to come right back, and we'll talk about that. So just give us a second here.
Hey guys, this is a short 5-minute break as a reminder, and I do know people are sending questions. Excellent. To bob@minervini.com. After this last section of selling, we will get into, we'll take a break, and then we will get into the question and answer session. So let's just take a quick 5 minutes though for right now. We'll be back with selling. Stand by.